David Cohen is back, joining us today from Boulder, Colorado. He's the founder and CEO at TechStars, the global accelerator and venture firm with over 1 billion AUM that has backed over 4,000 startups. Across their accelerator and funds, they've invested in 22 unicorns, including DigitalOcean, PillPack, Remitly, SendGrid, Twilio, Uber, Scopely, and Zipline. David also co-authored a book, Do More Faster, with Brad Feld, and before TechStars was a serial entrepreneur with multiple successful exits. David, welcome back to the show.
Hey, Nick, great to see you again. Also a failure in those startups. I got it all, yeah.
Yeah, right. Successes and failures. Well, you're not real if you don't have some of those.
That's right.
So David, last time you were on the show, June 26, 2018. I just looked it up. A lot has happened since then. Bring us up to speed on yourself and TechStars.
Sure. Well, great to be back. And I'm also back as CEO here at TechStars for about 16 months now as we're talking today. It's a little over a year. And that was after about a 4.5 year stint as chairman. So had stepped back a bit and was supporting, the team any way I could, but sort of working, maybe half time in that period, supporting the CEO. And so came back, again, about 16 months ago and sort of have my 3 recommitments I brought back to the company and excited to be back in the seat and jamming again. So we are now over 18 years old. We're now an adult here at TechStars. Maybe went through, as lots of folks do, the awkward teenage years, drank a little too much, partied a little too much, but now we've grown up and are sort of getting off into the real world again. So it's been quite a journey at TechStars, and I'm excited to be back at the helm again.
So why did you come back to run TechStars?
Well, it was an opportunity to do so. And I think I had that 4-year break where I was, maybe getting a little extra travel in and recharging my batteries, and felt like, that was a moment to really bring back those founding values, and kind of founder mode was the meme, if you remember, in that moment. And just felt like I had the energy for it and was excited to do it. Still have some years in me and some excitement about it, and love what it is. It helps so many founders around the world, achieve success or at least have a shot at it. And, the network is really powerful and awesome. So, it's a really unique opportunity and didn't want to pass it up.
So is this like a reboot, a refresh? How would you cast kind of this new phase for TechStars?
I would say it's a refocus. The three recommitments that I came back with, again, I like to call them recommitments because they're really nothing new for me and how I've always operated the business, in the first 14 or so years, which are one, we're here to help founders succeed, right? The founders are the customer. We have a lot of constituents around the network these days. As we have limited partners. We have, corporate partners around the system. We've got lots of mentors. There are a lot of partners that we work with closely to help founders succeed, but there's only one customer. So that's sort of number one, is really refocusing on the founder as the customer here. 2 is embracing startup communities. The way TechStars was built, we are really a product of the startup communities that we operate in. They are much, much more powerful than the few hundred people that we are in the organization. The mentors that contribute, the investors that contribute. We want to embrace them, help them feel ownership of the TechStars programs that do operate in their community. We're a part of them helping build that community to be a growing and thriving startup community over time. Many of them already are that. And, finally, the third one is more cultural. It's bigger isn't better is better, right? It's just a focus on quality and just being better every day for founders. So we've done things like, improve the investment offer and really, shore up the process that we're using to select companies. I just think we're getting higher quality across the board. So that's exciting as well.
So take us from like 30,000 feet down to ground level. If we start at 30,000 feet, what programs exist moving forward? What programs don't? And all the way down to ground level, talk to us about the actual, deal you do with startups. You hinted at it. It's changed a little bit.
Sure. So we coined the word accelerator. Brad Feld, my co-founder, coined that word a long time ago. And of course, it's caught on. And there are many, many accelerators around the world now. But, we are established in, most of the major startup markets in the world. We operate our accelerator programs in 10 or 12 countries, something like that, maybe about 20, 25 locations. So, we're operating where you would expect, right? In New York and Boston and, London and places like that. But also, here in Boulder, where I live in Colorado, places like Chicago or Atlanta or Toronto, Amsterdam, right? So we're sort of part of building, growing, thriving startup communities around the world as well. The process we use is a 3-month mentorship-driven accelerator. So we have many thousands of mentors who engage, many of the alumni that you mentioned in your open, engage and mentor and invest as well. There are about 20,000 unique investors that have invested in our portfolio, right? And so we get a lot of, investors, angels, venture firms looking at the output of our accelerators. The offer we make is pretty simple. We become essentially a co-founder to the companies that go through our program, and we have a 5% common stock interest, right, in those companies that go through the accelerator. And we also invest $200,000 of uncapped money, right? So it's just whatever the next investors come along and value the company at, we just convert our $200,000 into that. So we like to think of ourselves as a common stock co-founder. We become an investor also through that $200,000 uncapped convertible note. And that's a standard deal we do with every company that goes through the program. They get that 3 months of intensive mentorship, and they get that network of TechStars for life, which we think is really helpful.
And does that mentorship process, the 3-month cohort system, does that change or reshape or?
We're just focused on a quality group. So, we were previously running multiple times a year, for example, in a lot of places. And now we might just be running one time a year in that place. We also have virtual programs, of course, for people who can't be in that place. Cohort sizes tend to be 8 to 10 companies, so pretty small compared to some groups that like to have, 100 or 200 companies there at a time. We like to really focus on kind of 8 or 10, smaller class size, a lot of attention from the local community during our accelerator programs. So we've scaled through geography versus like trying to do it all in one program.
Perfect. And you did mention that you're going to shore up the selection process. Help me understand, and maybe the listeners understand what goes into that process and kind of how you think about identifying the standouts.
Yeah, so we're seeing large resurgence in applications, about 2 to 3x, I think 2.5x, something like that, in the last 3 or 4 years. So volume of applications that we look at, about 20,000 companies per year across the system. And we're picking, say 400 of those rough order against flexible, because it depends how many we pick for each class. So, it's a 1% to 2% kind of selection rate. We're using an investment committee process to do that most venture funds would be familiar with. Andrew Cleland, who's a 20-year venture investor, myself, maybe a little older than that even. Brad Feld, who's my co-founder, very, very long career in venture capital, and a couple of our most experienced managing directors. We look at every single deal across the system, and we, ask all the hard questions, right, of the folks that are bringing those deals in, because we have, dozens of managing directors that are outsourcing those opportunities, learning about them, engaging with them. So that, I think, is allowed us to make better selections, which has been great. I think we're feeling that in our programs. The newer offer that I mentioned has really helped us, attract some great companies now. And so, it's really just kind of a focus on making sure we're getting quality, not just volume of companies. We don't need to be funding thousands of companies a year. Mm-hmm. We need to find the best ones we can and help them be successful.
And how does the follow-on investment model work, from a capital allocation and a decision-making standpoint?
Yeah, so we have 2 strategies with our funds at TechStars, right? Strategy 1 is this accelerator investing, which is, again, this fixed amount, fixed equity, standardized deal when you get into our accelerator. But on the way out, we essentially have a pro rata investing fund, which is our follow-on strategy. So we're not trying to, take the whole Series A, but we're trying to sort of maintain, most or all of our ownership alongside those investors. And so we have a team that's focused on deploying that capital out of that second strategy that is looking at everything you would imagine, right? How did they perform in the accelerator program? We have pretty deep insight from that experience, tracking their KPIs. And then, of course, who are the co-investors? That matters as well.
Perfect. And, as you do this retrospective, think about the programs that worked best, the ones that didn't work as well. Are there certain characteristics that separate the most successful programs, not the startup, but the programs from the rest?
Well, in this business, as you know, it's all about the people, right? And so if you think about the real outliers, we had a program led by Andy Sack in Seattle that had 3 unicorns in 10 companies, right? And so,
whoa.
You sort of say, well, what's so special about that? Well, Andy, he put his heart and soul into it, is a strong and experienced investor. And so I think the managing director has a lot to do with it. Folks like Jenny Fielding, right, that had run the New York program, helped us source companies like Chainalysis, and Alloy and many others. It's the people, right? And so we just had our big FounderCon event as we're talking last week here in Colorado, and we had about 25 former managing directors, many of whom now run their own venture funds, come to the event and sort of teach and share some of their experience with the newer folks that are in the system. So we're really, we've got an alumni network of former MDs that are teaching the new ones and engaging with the system. And it's become a really nice mafia effect around TechStars. And so ultimately, I would say when you think back on it, it's always the people.
Awesome. Many of your biggest winners were outside the Bay Area. What advice do you have for founders that are building and scaling, outside of San Francisco?
You can do it. I mean, I think that, people can choose to live where they want to live. I think it's helpful to be in a vibrant startup community, and there are many now. A lot of the folklore of the Bay Area, I mean, it's obviously an amazing ecosystem, right? But most of the big companies that are there came from somewhere else, right? And, it is a great place to be, lots of capital, lots of other really smart people, but there are many great places to be. And you can always decide you want to have a location there or even move your headquarters there in the future. But anyone who says you can't build a great startup in Boulder or, Omaha or New York, I just think they're ignoring the readily available data at this point. You definitely can do it. So just go for it.
Are you seeing the gravity move back to Silicon Valley? It's sort of in this age of AI first everything? To
some degree. I mean, certainly AI, I think if you really want to be in the middle of it, you at least need to go there and sort of be in some of those conversations. But there's great stuff going on all over the world in that regard, right? And again, I don't think that all of the great, AI, which by the way, I just call software companies, will come from the Bay Area, right? I think they'll come from all over. And again, many of them will end up, being headquartered there or moving there because of the benefits of the ecosystem. But they'll start all over the world, and I'm seeing that already.
And what do you see in sort of the AI first companies that you're evaluating? What separates one startup from another?
It's interesting. I feel like they have what I guess I would refer to, and I think Andy Sack, who I mentioned earlier, refers to as AI first leaders, right? They're the AI first CEO. They just think that way. They operate that way. They're building that way from day one. And, it's been popular. I'm sure you've had folks talk about, the 10-person unicorn, right? Or when will we see the 1-person unicorn? I'm curious when we'll see the 0-person unicorn, right? That can happen. But they're thinking about those sorts of leverage and efficiencies from day one. It's not a CEO who just doesn't think that way, right? That's leading a bunch of engineers that do, that seem to be the magic combination.
So you're likely investing in a lot of companies that are using AI. Are you building AI into the programming at TechStars and into your approach?
Yeah. So Startup Weekend now is evolving to where, that's a event we run on the weekend to sort of source interesting founders around the world. And we run hundreds of these events every year. They're teaching obviously vibe coding right at the very beginning of that to people who don't know it or haven't seen it. The programs themselves, we're building virtual investment committee members, where our valuation process, right, where we're collecting feedback from companies. So we're using these tools. And interestingly, a lot of what gets built is from our alumni, right? We have a company called Sparkway, for example, that we're built by some alums that allow us to really more intelligently look for information in our own portfolio internally, right, that we can share with partners or other alumni. And, when you have almost 5,000 companies, right, it's a chore to figure out which is the right one to put in which situation, which investor with which partner, et cetera. And so just the ability to kind of surface data more easily, quickly. People can get something done in 10 seconds rather than 10 days.
Awesome. Lots of focus at the moment on this seed strapping concept, right? You mentioned the company of 10 or the company of 1 or maybe 0. I haven't heard that before, but
It's coming.
Pretty wild to think about. Let's just talk about the seed strapping model, right? We all know bootstrapping, but it seems it's extended and really talented 10X founders can do more with less. How do you think that affects venture and your model?
Well, right. I mean, you can find someone who can build something really huge with a pretty small investment, right? I mean, that's what, again, AI, smarter software is enabling. If someone takes a couple $100,000 from someone like us, that might be all they ever need, right? If they really hit the seam properly. So it's exciting for us. And we're seeing, some unicorns that are being built in 4 or 5 years. I expect we're going to start to see one, being built in 1 or 2 years. We haven't seen that yet in our portfolio, but you can sort of feel it coming and you see it in the market. So it's exciting because I think, what it means is less dilution, right? For someone like us that is sort of almost co-founding the company, part of the team at the beginning, to really go and do something big and meaningful without needing to rely on having to raise many, many, many rounds of capital. Of course, some of them will still choose to do that.
So does that suggest that the new companies enrolling in the program shouldn't change much, but the follow-on capital demands will?
No, I just think that it's a mindset, right? Some of them have where, maybe in the past they were bootstrapping, right? And literally, I mean, I always define bootstrapping as raising as little as you can, not raising nothing. And I was a bootstrapper in my first company. We raised literally $100,000, right? And built a company, sold it to a public company. And that was a great outcome because we owned like 95% of the business, right? When we sold it.
Yeah.
And different businesses need different, amounts of capital or different situations, right? Based on what the company's doing and what it needs to really grow and be successful. But I think this attitude that you now see is like, well, for me, it's not about building some big organization, right? It's about having a big outcome. And if I can do that with just a few people or without having raised a lot of capital, that might be better. And I say to myself and those people who say that, yeah, duh, I've seen that, right, in my own career. And I've seen that in some of our companies. And it's definitely really, really powerful. I just think the opportunity in this moment where software is helping so much, where maybe you don't need so many developers, right? They're expensive because you can just, get the code from the software, right? And that is what's new and really powerful. So I think people are seeing that and they're not necessarily saying, hey, I want to go out and raise $100 million. They're saying, wow, look, I've got 5 or 10 million already in revenue and I can just scale this way.
What do you think? I mean, you've seen a lot more than most of us, right? You've been around for a while. You've had 22 unicorns. You've probably worked or shared cap tables with more VCs than maybe anyone. How do you think this affects venture?
Well, I think people are there's always a cycle, right? And I've seen this cycle 3 or 4 times in my investing career now where, it becomes really fashionable to go earlier, right? And the really big funds go off and launch, these seed programs and, maybe an accelerator or venture studios that try to get there really early. So I think you will see the general market recognizing this trend saying, well, maybe we need to be there first. Right. And so, again, for us, it's exciting because we are there first. We're sourcing around the world. And, when we say, hey, this one's special, you should look at it. Right. People pay attention because they see this dynamic. I think you'll see that wave again where, the large firms will try to go earlier. But, it does take, it's a different attitude. It's a different set of skills. It's again, we're people on the ground all over the world. That's hard to replicate, hard to get right. And it swings back and forth, right? The market will then change again for some other reason, and it'll be fashionable to, not be in the early stage. And that's why you see these big venture firms building programs that they sort of abandon and go back to, maybe every 5 to 10 years. So I think you'll see some of that.
It's funny. Before we leave the capital efficiency point, we can all look at amount of capital raised versus progress as sort of a capital efficiency metric. What other behaviors and signals stand out to you about the least capital efficient and the most capital efficient when you're investing in companies that are so early? You know, so many of these companies are still in kind of that discovery phase or wilderness phase. Yeah. And there's not a whole lot in terms of traction or real metrics to sink your teeth into. So like, how do you find the founders that have this hyper capital efficient mindset? Yeah. And does that matter even?
Well, I don't know that that is the specific thing we're looking for. I think we're paying attention to it in this moment. And I would say in my own investing career, I would associate that sort of capital efficiency, or, you know, what I would maybe just loosely call cheapness or stinginess, right? Mm-hmm. With, you know, success, right? I mean, I've seen founders who are just, you know, don't want to spend money they don't have to spend. And I personally have seen that be really important. It's, you know, they will spend when they have something they really believe in, but it's not about how do I go through the money because my investor wants me to go through the money, right? It's more, you know, what do we have to spend on? What's really important? And that I don't know what the right word is. It's not cheapness. It's a stinginess about how they spend their capital. And I personally identify that way too. You know, the businesses I built, I told you the first one was bootstrapped. I try to raise as little money as possible outside the funds for the business itself, even in the TechStars business. So, you know, we look for, you know, team, you know, market progress and idea. You know, that's sort of our focus. And I think you're looking for founders that really understand what they're trying to change in the world, have a vision about it, and are values oriented. They're going to build culture around the values that they care about. And they're going to hold on to like, there's something that they believe, right, about how you build a company. It could be capital efficiency. It might not be. Some of the best companies we've had come through the program also raised an awful lot of money because they had to. And, you know, that founder knew they were going to have to do that and was clearly going to be strong at it as a storyteller. And so it's sort of, you know, founder company fit, right, that we're looking for.
Yep.
And, you know, I think we used to focus really heavily on the ability to build stuff. And now, like in this early stage, that's not as important, right? You can quickly prototype and get your ideas out there, attract, you know, capital, resources, people to be able to do that down the line. So the world is changing, but fundamentally, those are the things that we're focused on.
So let's talk a bit about verticals. TechStars recently launched vertical networks around certain industries. What industries do you feel like are underestimated and which are maybe too crowded?
Underestimated is a tricky one. It's, you know, I think that you have to look at the moment, right? The moment we're in with AI clearly is a thing. I think it's dwarfed by quantum computing in the future. I was in a great conversation at our FounderCon where a bunch of quantum entrepreneurs were saying, you know, if you took all the computing power in the world right now and you applied AI to it and you let that evolve for, say, 50 years, it wouldn't be able to do what one quantum computer is going to be able to do, right?
Wow.
And so, you know, we're about to see computing totally change, probably in the next 5 to 15 years. Right. It's not as far off as I think people think. And it's that, you know, quantum is not just faster or better. It enables compute against things that we don't, you know, we can't do today. Right. We're not able to compute these answers. So healthcare to me is the ironically killer app of, you know, of quantum meets AI. I think, you know, we're going to see some amazing, you know, personalized medicine, you know, the pill that you have to take for your body and your situation. I think that sort of thing is coming. And I think it's going to have profound impacts in terms of, you know, life expectancy, lifespan, you know, aging, disease, all that stuff. So it's not underestimated today. People put a lot of energy into healthcare, but I think the opportunity is just enormous in the next couple of decades. And that's how I think as an investor.
And where are we at in quantum? You know, what inning would you say that we're in?
Oh, I mean, you know, we're maybe like warming up in the dugout, you know, like, you know, maybe we're going to step up to the plate to see the first pitch here pretty soon. In that analogy, it's got a long, long way to go. But there are really big companies being built in the infrastructure of that because everybody wants to be the first one there. I mean, the first government, the first organization with true quantum compute power, you know, nothing that works today, encryption or, you know, things like that work in that world, right? And so We're already talking about quantum safe encryption, right? Like it's got to be much better in that world. So very, very early. I don't know that I'll be able to see it all, but I hope to see some of it. And I think it's going to be really, really profound in a way that, when the aliens land, right, in 100 years and they say, like, what happened during that 100-year period? Oh, the internet, so they could communicate, right? Oh, AI, so their software got really smart, right? Which again is what that is to me. And they figured out how to actually do, computing at a new level. That's why the world changed in that 100-year time span in super profound ways.
I mean, that could fundamentally change all the infrastructure around compute, right? Like
all of it. I mean,
I feel like
we think about like fiber optics as the way that's not how you would transfer entangled information, right? Like it's a new set of infrastructure, physical, compute, data center, power, all that stuff.
I mean, I feel like I've asked a number of very smart investors on this show if NVIDIA will still be the dominant infra player, 10 years from now. And most say yes, but I just, it's hard to predict the timescale for quantum, but I just feel like paradigm shifts catch everyone off guard in new ways. And that's why the S&P is different than it was 10 years ago and 50 years ago, in many cases, none of the same names.
That's right. I mean, what is it? Half of them turn over every, 5 or 7 years, right? Like already. And in this world, I think you're right. I mean, who knows is the answer. No crystal ball about it, but there will be new companies that are really in strong positions that really take advantage of these intersections. Okay.
So it's a perfect segue here. The next thing I had written down is, as you think about the next decade, what's one trend or belief in venture that you think will be completely irrelevant 10 years from now?
Oh, gosh. I guess I'd probably say there's something about the where you have to do it thing, right? I think sort of the ecosystems of geographies, right? That sort of belief system, you'll be able to do, great startups anywhere in the world. I think that will be gone. I think that probably the more interesting one is like the asset class of venture. Today it's thought of as risky and, sort of swing big or, go big or go home as an asset class. And I just think that's going to evolve in 10 years. Vanguard invented the index fund, right, to make investing in public markets more stable and safe. There's no reason that sort of thing wouldn't happen in venture. All mature asset classes eventually learn that, diversification matters. And I feel like you're just going to see venture become like a more of a science than an art in about a decade's time. I think that's a possibility.
A few here to wrap up. David, if we could feature anyone on the show, who do you think we should interview and what topic would you like to hear them speak about?
I'm sure my mom would love to be on your show. I think, I would be fascinated by, maybe this is like way out there, but somebody, like a Warren Buffett, right, on venture capital. Right? Does he think we're just all a bunch of idiots? Right? Or does he think that it is evolving into an asset class? Does he think that it's viable? Right? Or is it gambling or speculating, as he would call it? I think that would be fascinating to hear about.
David, what book, article, or video would you recommend to listeners?
Oh, Brad Feld just published Give First. It's a philosophy in business. I love it. I've tried to live it. It's a TechStars value and mantra. I think as a business philosophy, it's game changing. So I'd recommend that.
We just had him on. It was awesome. It was an incredible discussion. David, do you have any habits or behaviors that are a secret weapon?
I don't know if it's a secret weapon. I'm a big believer in, sort of adding value to networks, right? And virtuous cycles around networks. I give, obviously TechStars is a big network. Endeavor, I'm involved there. I just feel like I know so many people in so many places. This ACES GP community I've been sort of getting involved in and just trying to add value to them as a way of giving first to them. I've seen it really come back and pay off in very unexpected ways that aren't transactional. So try to do that and feel like that's really helped me in my life and career.
And finally here, what's the best way for listeners to connect with you and founders to learn more about TechStars?
Oh, it's just techstars.com. My email is just david@techstars.com. I think the kids are still using email, so that works fine. But I'm on all the social thingies as well. I'm pretty easy to find.
All right. Well, he is David Cohen. The firm is TechStars. David, thank you for joining us again, and best of luck with early adulthood, I guess, now that you're past the awkward teenage years.
Thank you so much. Great to be with you.